Gold metal, the bullion itself, has been an outperformer this year relative to other risk assets like cryptos and stocks. But what about the gold miners? Those seem to have taken a hit along with the rest of the equities indices. Well, we're here to discuss the future of gold miners and the metal itself with Sean Fieler, CIO and President of Equinox Partners. Equinox Partners is a fund dedicated to investing in the gold space on the equity side. Welcome back to the show, Sean.
Thank you, David.
A lot of investors right now in the gold space are probably looking forward to having advice from a professional investor like yourself who has had years of experience working in this field, working across all jurisdictions around the world. Let's start with the macro overview, and then we can talk about your own investment philosophy and what investors should do right now in this turbulent minefield of an environment. So as you know, the Federal Reserve has been raising interest rates. Their latest meeting minutes came out last week. And let's summarize those meeting minutes for the audience here. I think, to my knowledge, it was not as hawkish as what some people may have anticipated it to be. How would you interpret what the Fed's latest statement to be?
Yeah, I think, despite raising rates, especially every time Powell gives a press conference, he kind of undercuts his determination, I think, to come across as really tough or really achieve lower rates of inflation at all costs. He just comes across as too, I think, equivocal. And so while the Fed is getting credit for raising rates and the markets are expecting another 50 to 70 bips at the 75 bips at the next meeting and another 100 bips this year, I don't think the Fed's really getting credit for solving the inflation problem at the expense of all the other variables.
Okay, but do you think that more rate hikes right now are just, I guess, more philosophically speaking, necessary at this point, given that the Fed's mandate is to fight inflation? And some would argue that even another 25, 50 basis point or a 75 basis point rate hike is not going to make much of a difference at this point.
Well, I think it will make a difference. It'll certainly make a difference to capital markets. But, the last inflation print's 8.5%. Policy rates are at 2.5%. So the Fed started way behind the curve. As to how far they get to go in terms of raising interest rates until they get a good inflation print that they can live with, or until something breaks in the capital markets, I think that's really what we're going to be watching for over the next 6 months.
Okay. Now, the strong dollar has been a culprit to, gold prices staying stagnant, some might say. Now, the strong dollar can partly be attributed to rising interest rates and a hawkish Fed. Now, do you think that the dollar can continue to see strength throughout the remainder of the year, Sean?
Well, it's been on a tear. So, I'm not trading dollar euro, dollar yen cross rates. So I don't have a strong opinion. I will say that from a junior mining perspective, the weakness in the euro has been a real help to our investments in West Africa, where you've had really moderate rates of inflation and a weakening currency. Throughout the rest of the world, we're seeing flat to down gold prices really weighing on the top line of these gold companies. At the same time, we're seeing teens increases in terms of their actual cost. And so you're seeing that margin squeeze. Okay.
Sean, let's just summarize the gold market for the audience then. I would say let's start with the tailwinds and the headwinds. What are some of the tailwinds or potential boosts to the gold price that you see?
Well, you have continued central bank buying. That's been, I think, a real positive. You have increased Asian demand, especially Indian and Chinese demand. So I think there's some good signs out there on the demand side. I think, as we go now into year 12, 13 of annual central bank accumulation of gold, that's a factor that doesn't seem to be waning, but if anything, I think looks to be increasing in the coming years. And so I would say that would be the single most positive factor for the gold market. The negatives, I think I just addressed the principal negative, certainly in terms of the miners, is this margin squeeze where our inflation in the mining space is north of what you see in the CPI print. And at the same time, you have gold prices down 5% for the year and silver prices down almost 20%.
Headwinds then. So I've listed a few already: strong U.S. dollar, rising interest rates. Are those potentially going to remain as headwinds, do you think?
Well, I hope not. The dollar's been on a tear, so it's not clear how much farther that can go without something in the financial system breaking. I don't see the inflation rate at a lot of mining projects moderating. The other thing that we've had is certain jurisdictions, really almost the entirety of Latin America, where you've had a number of governments just adopt very hostile regulatory positions vis-a-vis the mining sector. And so, Chile's the latest, but, Mexico's been doing it for years and just making mining a lot more difficult than it needs to be. And when you add that to the other factors, it just makes the business a lot less attractive than it should be.
Fair enough. Let's talk about inflation a little bit more. So, as you know, the highest inflation rate in the last 40 years. Some would say that this is the start to even higher inflation rates. Some might also argue that this is already the peak, as we've seen the latest CPI print came down from 9.1%, which was the earlier highest reading. Sean, let's start with your view on inflation. Do you think this is the peak? And then we'll talk about how this affects gold.
So short term, this may very well be the peak. The problem is, like the 1970s, just because you get a couple of good prints doesn't mean that you've really put the inflation genie back in the bottle. And so I think we could very well have a situation where we're able to get, a mid-single digit CPI print, but that doesn't guarantee that we're going back to 2% long-term inflation rates. I think 2% long-term inflation rates are just unlikely, and I don't think capital markets have really fully internalized that shift that we've made from decades of benign inflation to what is likely to be a prolonged period of time with unattractively high rates of inflation.
Okay, fair enough. Now, Sean, inflation, has that affected the junior mining space at all? Has that impacted their costs?
Yes, it's been horrible.
Because I asked that because some junior miners have actually said no, because fuel, drilling, not a large percentage of our costs. It's mostly on the wage side, but even then, they've only got a few people in operation.
Well, that certainly hasn't been my experience. I'd say that the junior miners are suffering from the cost increases, and
okay.
Where the cost increases have become most problematic is for companies in construction. So where you've just seen the blowouts on the capital estimates, and then their inability to really get that number right despite revising it several times. And so where on the operating side, you see companies revising high single digits to low teens or mid-teens, on capital budgets, you can see 20, 30% cost creep go to 40, 50% cost creep. And so it can be a lot more damaging. And then they don't necessarily even have the capital to finish their projects. And so you've seen companies had to top up their financing in particularly punitive ways for capital projects they've already begun. We've seen a number of those deals this summer, and it's been very ugly.
Okay. Have you encountered scenarios in which projects have to be postponed or stalled because they couldn't afford certain operations?
Well, usually the cost of postponing a project are so horrific that doesn't happen. You just do whatever it takes to actually finance the project, especially if you've already begun construction. So Argonaut's a good example of that, where they had to finance with the stock down, I think 40+% on the day of the financing, to have the capital to move that project forward. And if you looked at the alternative of mothballing the project, putting it on care and maintenance, and then restarting, the logic of just financing and moving ahead became the clear choice, despite it being enormously punitive. I'd say the only geography we were really seeing projects come on time, on budget, has been West Africa. And that's been true for a number of years, but in this inflationary environment, I think that's the gap between the West African and the other projects has gotten even larger.
Okay. All right, let's come back to junior mining and your investment philosophy for junior miners, but let's close off on gold first. So, as I was saying, inflation has been, a major theme among investors this year, but inflation hasn't really picked up, or at least, inflation hasn't caused gold to pick up, rather, in a way that some gold investors may have hoped it would. Gold has stayed flat, gold has outperformed stocks, but it hasn't outperformed CPI since the beginning of the year. Can you offer an explanation as to why?
Well, it's enormously disappointing, right? You have high inflation, the Fed behind the curve, and gold going down rather than up. At the same time, your costs are going up. So it's been a horrible experience as an investor in the space. I think the long-term fundamentals for gold remain very positive. I think the idea that central banks in the first world in general, and the Fed in particular, are going to be able to solve our inflation problem in some kind of convincing fashion is unlikely. And that's an environment where I think gold continues to remonetize. And then one of the most amazing things in the gold market is this idea that really the creators and managers of the alternative to gold, fiat money, they're the largest single buyer of gold. I think that tells you something very profound about gold's long-term prospects.
So overall then, summing up, use the word disappointed to me online and offline. How long can this disappointment last, Sean? What is the ray of light at the end of the tunnel?
Well, look, I mean, the idea that we're sitting here in late August and the GDXJ, so the Junior Gold Mining Index, is down more than the NASDAQ, right? In what is the watershed correction year for the NASDAQ is kind of shocking. Yeah, that seems to me to be out of line with underlying fundamentals. I think from a stock picker's perspective, it's an opportunity. But even if you're outperforming, for the first 7-8 months of 2022 in the gold mining space, you're probably still not making money. So it's been a very tough environment.
Okay. All right, let's talk about the junior miners now. The GDXJ, the index that you were just talking about, the VanEck Junior Gold Miners ETF, was down tremendously since the beginning of the year. Interestingly, Sean, it has followed more or less the equity indices, like you mentioned the NASDAQ as one example, more so than it has followed the gold price. In other words, if you assume that a miner were to be tracking gold, it should stay flat, but that's not the case, right? What happened this year?
Well, so you have this combination of horrible factors, which is, rising costs and declining top line. So, if you're looking at a mine life of 8 or 10 years and you run those trend lines out, right, the future value of cash flow that you're getting is less than what you're getting this year because you're discounting those cash flows back. But then those future values of cash flows that you're getting are also declining in nominal terms because your gold price is going flat to down and your costs are going up. And so it's really difficult to get bullish or optimistic about this space unless you believe in meaningfully higher gold prices, certainly so long as these kind of cost pressures are going to persist in the industry. So I think it's overdone. You have some companies where, like Dundee Precious Metals is a good example, where you have a company with no debt that's going to have half its market cap in cash at the end of this year. So you have some things that are just really anomalous, really interesting, very cheap. You have some top 10 gold mining companies that are generating dividend yields and share buyback returns together towards 4 or 5% and total free cash flow yields of close to 10%. But unless you see that gold price start to move up in terms of longer term expectations, it's really hard to be bullish long term about the sector.
Now, let's talk about some of the holdings that you've had that have outperformed, and we'll talk about maybe why they've outperformed and why they have maybe been outliers in this, as you would say, dreadful, horrific environment.
I wish I could be more optimistic. So yeah, I just took 2 trips. One was to Burkina Faso. We went out and saw the Bombori mine that Orezone has, and then we saw the Sobrado mine that West African Resources has. And those were both really interesting in that one's a development project, another is a ongoing cash flowing operation. But both running very well and both benefiting from this combination of factors they have there in West Africa of a currency linked to the euro. So they've benefited from the euro's decline against the dollar. They have abundant labor, so they don't really have labor issues. And they've had a government, in the case of Burkina Faso, that hasn't been tinkering with their royalty rates, hasn't been hassling them with respect to permitting and doing business. It's been a good environment to build and operate a mine this year. And those are 2 stocks that have really performed well.
Okay, let's drill down a little bit deeper. So in terms of their operations, what are they doing differently that have made them outperform?
They're executing on time, on budget. They're generating gold at an attractive margin with a low all-in sustaining cash cost. And they haven't been really impacted by this series of factors that's really made mining, and gold mining in particular, a much more miserable business in a lot of geographies. So they haven't been shut down by NGOs or protested. They haven't had wage negotiations that have gone awry. They haven't had capital budgets that have blown out. They just haven't had, they've basically done what they said they were going to do. And in the case of WAF, West African Resources, they've been able to execute on a couple acquisitions and really grow their company's long-term prospects at very attractive prices in a down market in the sector.
Okay. Well, it sounds to me like some of it is just luck. They were in the right place at the right time.
Well, I mean, this has been a good geography to be in for decades, right? This is where Bristow built Randgold, right? That allowed him to merge into Barrick to manage the largest gold mining company in the world, right? So this has been a really good geography for a long time for a variety of reasons that have everything to do with the geology, the topography, the regulatory environment, the currency environment, the local culture. I mean, there's a long list of reasons why this has been a good place to do business. And similarly, if you go to you can pick most of Latin America and you can go through that same list, and instead of a positive, you can come up with a negative on almost every single one of those points.
Okay. Well, Sean, looking forward then, I think a lot of people would like to know some tips or advice that you might have for a retail investor picking his own junior mining stock. What are you looking for in your portfolio?
Well, look, the number one thing we solve for is alignment of insiders, and not just the C-suite, but also the board. And that's something every single investor can do. It's not a technical undertaking. But if the people making decisions about how the capital is going to be allocated, what that company is going to do, don't really have a meaningful financial alignment with the shareholders. Whether or not that's a bad thing this year or not, it's hard to say, but over time that tends to catch up with you. And the Goldfields Yamana deal is just I think, a great example of lack of insider ownership gone awry. So technically very competent company, world-class assets, and the board votes to do a deal that's not accretive on any known metric. That's the kind of thing that you just can't have as an investor in the space.
Finally, Sean, looking ahead then, which jurisdiction do you think will come out on top when everything recovers, when the recession's over? Which area, which sector of the gold mining business do you think will outperform?
Well, I mean, it's not just, a jurisdiction is one factor. A bad asset in the right jurisdictions, and that's still a bad asset.
Sure.
As to whether or not we've seen the turn in Latin America, which has really been the biggest problem and weighed on our portfolio, it's not clear. So you have Chile, which is just going down the path of how much harder they're going to make it to do business there, to Mexico, which is, years in and doesn't seem to be moderating at all in terms of their strategy vis-a-vis the mining industry, to Guatemala, where you have a president that is pro-mining in Gimonte, but can't get anything done. I think he's going to get Escobal back online, but it'll have taken him 3 of his 4 years in office to get a built asset that doesn't have any real environmental issues and very, I think, obscure made-up social issues back online. As to whether or not he's going to be able to permit anything else, I think is still is an open question. So, those are the two that kind of stand out in my mind as the best examples of easy and more challenging places to operate.
Okay. Sean, wonderful talk today. Thank you for sharing your insights and your advice, and I look forward to catching up with you soon. Best of luck with your fund.
Thanks, David.
And thank you for watching Kitco News. I'm David Lin. Don't forget to subscribe to our YouTube channel.